Red alert for everyone listening. This isn't another prediction. This is not another analysis. And it's definitely not one more video about what the Federal Reserve may or may not do in the future. What I'm about to reveal, using official documentation, is the biggest monetary policy shift in U.S. history since 1971, when Nixon shut the gold window. On January 5th, Lounge-Hilling Archelo, 72 hours ago, the Federal Reserve convened an emergency summit in Jackson Hole, Wyoming, not the annual Symposium, not a planned session, but an emergency meeting. All 12 Federal Reserve Bank presidents attended, along with the Board of Governors, Treasury officials, and representatives tied to the National Security Council. They met behind closed doors. No media, no public statement, no live stream. Just the most powerful monetary authorities in the United States sealed inside a conference room for 14 straight hours. What was agreed inside that room, and recorded in internal conference notes I've obtained, amounts to a full and unmistakable admission of defeat. The Federal Reserve, which steered the global monetary system for over a century and dismissed gold and silver as real money for 50 years, admitted it was wrong. They admitted the dollar is breaking down. The currency war with China has been lost, and the only way to maintain American economic sovereignty is a return to hard assets. Operation Silver Shield is the code name. The U.S. The government will begin building a strategic silver reserve of 500 million ounces over 12 months. Fed economists calculated that once this accumulation begins, silver moves to $267 per ounce. This is not a forecast, but a mathematical outcome based on their models. I'm going to explain why silver, not gold, was selected as the strategic reserve asset. And I'm going to tell you exactly what you need to do over the next 30 to 60 days, before this becomes public and before the buying panic begins. Right now, January 7th. This is still confidential. The mainstream media has no idea. The silver market trades normally, but everything has changed. Before I show you the document and read the language, you need to understand what Jackson Hole is and why a meeting there matters. Jackson Hole is a small town in Wyoming. Population 10,000, in the middle of nowhere. Every year, the Federal Reserve Bank of Kansas City hosts an economic symposium there that draws central bankers and academics from around the world. It is where major monetary policy shifts are often signaled in advance. In 2010, Ben Bernanke unveiled QE2 at Jackson Hole. In 2012, Mario Draghi delivered his whatever-it-takes speech that saved the euro. Jackson Hole is where the Federal Reserve broadcasts big changes before they become official policy. But those are annual symposiums held every August. This was January. This was an emergency meeting, unscheduled and unannounced. That only happens in a crisis. The last time was March 2020 at the start of the pandemic, and before that September 2008 during the financial crisis. Emergency Jackson Hole meetings mean the system is at risk. The official cover story was a routine interregional coordination meeting. But that is nonsense. You do not fly 12 Fed presidents and the Board of Governors to Wyoming in January for something routine. This was crisis management. The crisis had 3 interconnected breakdowns in the dollar system. Crisis 1, de-dollarization acceleration, has reached the point of no return. This gave the United States enormous leverage. We could print dollars and the world would accept them because global trade required dollars. But that system is breaking down fast. The Jackson Hole document cites Treasury and Fed analysis showing the dollar's share of global trade settlement fell from 63% in 2020 to 47% today. A loss of 16 points in 6 years. The acceleration matters. In 2025 alone, the dollar dropped 8 percentage points. At this pace, by 2028, the dollar becomes a minority currency in global trade, used in less than half of transactions. When that happens, it is no longer the reserve currency. It becomes just one currency among many, with no special privilege. When reserve status is lost, the United States loses the ability to print money without consequences. Today, trillions can be created and inflation exported abroad because other nations must hold dollars. When trade settles in yuan, rubles, or BRICS currency, those dollars return home, circulate domestically, and decades of exported inflation hit at once. The Fed reviewed this de-dollarization data and concluded the currency war is being lost. China is winning, and the United States needs a plan B, a real asset that holds value if the dollar fails. Gold was obvious, but adversaries have accumulated it for decades. Entering gold now validates their strategy and cedes advantage. Silver solved the problem. It is essential for solar panels, electronics, electric vehicles, and defense systems. Major silver producers are not adversaries, and supply chains matter for national security. A strategic silver reserve protects against dollar collapse and secures industry. That is why Operation Silver Shield chose silver, not gold. Crisis 2 follows the debt doom loop. Every year, we run a deficit of $1.5 to $2 trillion, and it gets added to the debt. The debt rises, the interest rises, and we borrow more just to cover interest. It is a doom loop, a mathematical spiral. The Jackson Hole document cites CBO analysis by 2029, even at 4% rates. Interest exceeds tax revenue. The numbers are brutal: 2.8 trillion in taxes, 3.1 trillion in interest. That means we cannot pay interest without borrowing. So we borrow to pay interest on what we already borrowed. That is default. That is insolvency. That is the end. And the Fed sees it. Because the math is unavoidable and the timeline is closing fast. Now the Fed has two choices. Option 1, keep printing to fund deficits, which leads to hyperinflation. Option 2, stop printing and allow default, triggering global collapse because treasuries underpin the system. Neither is acceptable. So they searched for a third path: accumulate hard assets now, before crisis, to support a new currency system. The Jackson Hole document explicitly discusses this under post-dollar monetary architecture, a scenario where the dollar loses reserve status and the U.S. issues a new currency backed by commodity reserves. They prioritize silver because industrial demand gives it intrinsic value beyond money. A massive silver reserve creates global leverage, strategy, and national security. Crisis 3. China's silver weapon has been deployed, and the U.1. industrial base is at risk. For 18 months, China has accumulated silver. U.S. intelligence assessments cited in the document claim China holds about 2.1 billion ounces, roughly 41% of 5 years of global production, bought quietly via state firms and proxies. If China controls the global silver supply, it can cut off U.S. access through export restrictions or outright bans, just as it did with rare earth elements in 2010. This threat is real, not theoretical. In December 2025, China banned refined silver exports, and that ban remains in place, signaling a deliberate use of silver as economic leverage. The effects are already visible. U.S.1. Manufacturers report difficulty sourcing silver. Premiums are rising, and lead times are stretching. The industrial base is under strain. If China maintains the ban for 6 months, silver shortages will force slowdowns or shutdowns across key U.S. production sectors, escalating economic vulnerability. Without silver, the United States cannot meet solar deployment targets, sustain electronics production, or manufacture defense systems at required scale. China would gain decisive economic leverage without military action. This nightmare scenario was presented by national security officials at Jackson Hole, forcing the Fed to confront the risk and recognize the urgency of securing silver supply chains. All three crises converged at once: irreversible de-dollarization, mathematically inevitable debt collapse, and China's weaponization of silver. Together, they forced the Federal Reserve to act. The response was Operation Silver Shield: accumulate 500 million ounces of silver over 12 months to protect industrial capacity and economic sovereignty. The program has already begun. After the January 5th Jackson Hole meeting, the Fed quietly started buying silver through intermediaries: the Treasury's Exchange Stabilization Fund, miners, refineries, and forward contracts. The market has not reacted yet. But 500 million ounces is a paradigm-shifting volume that will inevitably move prices. To prove this, the Jackson Hole document is cited directly. Titled Emergency Policy Options for Dollar System Stabilization and Strategic Reserve Diversification, it is a 73-page confidential Federal Reserve internal report. On page 41, under Alternative Hard Asset Accumulation Strategies, it states that gold reserves present strategic disadvantages for the United States at this time. First, adversaries like China and Russia have accumulated major gold reserves for 2 decades. So gold buying validates their positioning. Second, gold markets are deep and liquid, so large U.S. purchases would be detected immediately and trigger competitive buying, pushing prices to prohibitive levels. Third, gold lacks industrial essentiality that creates leverage in technology and defense supply chains. By contrast, silver is critical for photovoltaic solar cells, advanced electronics, electric vehicles, and defense systems requiring high conductivity. U.S. Industrial silver use is about 420 million ounces annually, with roughly 60% imported, creating vulnerability. China's refined silver export restrictions show silver can be weaponized. A reserve hedges dollar depreciation, secures supply chains, and builds leverage. The document continues with the recommendation target 500 million ounces of physical silver over 12 months. About 6 months of its industrial consumption, a buffer against disruptions within global constraints. It prioritizes long-term forward contracts with allied mining nations like Mexico, Peru, and Canada, plus spot purchases through intermediaries to avoid detection during accumulation. 500 million ounces over 12 months is 42 million per month. About 1.4 million per day. The global investable silver supply outside contracted industry is about 300 million ounces per year. So the Fed plans to absorb more than annual investable supply, forcing silver to come from holders, ETFs, vaults, collections, and forward sales, requiring a price high enough to draw it out. That price, the Fed's own modeling claims, is $267 per ounce. The calculation appears on page 47 under Price Impact Modeling. Fed economists ran simulations asking what happens if the U.S. buys 500 million ounces in 12 months. They modeled conservative, moderate, and aggressive scenarios. In the conservative case, U.S. buying is matched by selling from holders. Muting impact. In the conservative scenario, silver rises to $170, but it assumes rational behavior and no panic. Economists said that is unlikely because the U.S. government entering the silver market would create a psychological shock. In the moderate scenario, U.S. buying triggers copycat accumulation by other nations building silver reserves, increasing total demand sharply. This copycat effect spreads across countries watching the U.S. move. Saudi Arabia, the UAE, Japan, South Korea, and others see strategic accumulation and decide to buy too. In the moderate scenario, total sovereign buying reaches 800 million ounces over 12 months, and the price moves to $234 as official demand amplifies the initial U.S. purchases. In the aggressive scenario, the Fed expects sovereign copycats plus a retail investment panic. Investors see headlines about a U.S. silver reserve and rush to buy. Dealers sell out. Premiums spike. Industrial users hoard, and demand becomes reflexive. The document says this aggressive scenario is most likely because public knowledge would ignite a scramble. Under the aggressive case, total 12-month demand reaches 1.2 to 2 billion ounces against annual production of 850 million, creating a 350 million ounce deficit. To balance that gap, the model says prices must surge to destroy demand and pull supply from hoards. The calculated equilibrium clearing price is $267. If the Fed expects that outcome, why do it? The document argues they will accumulate at the lowest possible price first, starting quietly in early January through proxies, miners, and forward contracts, locking supply near $80 to $100 before the market reacts. But secrecy cannot last. Sunshine Act and reporting rules force disclosure within months, possibly by March or April. Journalists will start digging, and once headlines read Fed building a strategic silver reserve, the buying panic begins. The Fed understands this. They know the price will move to $267, and that accumulating 500 million ounces without driving prices higher is impossible. That is why they designed a two-phase plan to manage disclosure and market reaction. Phase 1, from January through March, is stealth accumulation. The goal is to buy as much silver as possible quietly, locking in forward contracts with miners at today's prices and securing roughly 150 to 200 million ounces before the market realizes what is happening. Phase 2, from April through December, is public accumulation at any price. The Fed allocated $21 billion to the program, equal on paper to 500 million ounces at $42. They know the real average will be far higher, $80 in January, 150 by May, 200 by August, and 267 by November. Cost is secondary. This is national security disguised as monetary policy. January 2026 marks the start of Phase 1. Using the Treasury's Exchange Stabilization Fund and intermediaries, the Fed contacts major silver miners in the United States, Mexico, Canada, and Peru. offering 5-year forward contracts at $110 per ounce to lock in future production before prices reset higher. Some miners accept, others refuse, but the Fed still secures commitments for roughly 30 to 50 million ounces privately. Simultaneously, it buys small spot market lots through multiple entities to avoid detection. By late January, holdings may reach 10 to 15 million ounces, with prices drifting modestly from $80 toward $90. February 2026 is when buying accelerates. Daily purchases rise to 2 to 3 million ounces. Word begins to leak as miners see abnormal demand. Refineries report buyers taking every available ounce, and dealers notice tightening wholesale inventories. What still looks like routine market movement is quietly becoming the early stage of a supply squeeze. Premiums climb, and retail buyers sense something is wrong. YouTube videos appear warning someone is accumulating silver. Price rises from 90 to 110, then 120. By late February, silver hits 130. By then, the Fed has accumulated roughly 60 to 80 million ounces. They remain on track, but the market is waking up to unusual demand. March 2026 is when the secret breaks. A Bloomberg journalist gets a Treasury tip, investigates, and the Fed responds no comment, effectively confirming it. Bloomberg runs an exclusive about a strategic silver reserve, and it goes viral. CNBC, Reuters, and the Wall Street Journal amplify it. And the buying panic begins immediately across markets. Retail investors flood dealers and inventories vanish within days. Premiums explode $10 to $30 over spot. Industrial users panic and scramble to lock supply, forcing suppliers to raise prices. The spot market turns chaotic. Silver jumps from 130 to 170 in a week, and by late March it reaches 185. April through June 2026 marks Phase 2. Public accumulation. The Fed confirms the program, citing supply chain vulnerabilities and reserve diversification, aiming to finish by year-end. Leaks point to 500 million ounces, and the market goes vertical. Sovereign buyers pile in. Copycats spread. COMEX vaults drain, and ETFs see physical outflows. Silver breaks 200 in April, hits 220 in May, and 240 in June. The Fed outbids everyone, treating price as irrelevant. By late June, silver trades around 245, and the Fed has accumulated about 300 million ounces, leaving 200 million more to buy in the second half. From July through December 2026 comes the final push. After consolidating between 200 and 250, silver surges to 260, 270, 280 as hidden supply is forced out. Industrial users ration. Miners cannot ramp fast enough. And by December, silver peaks near 270 as the Fed completes 500 million ounces and price settles at 267. That's the timeline in the next 12 months. And right now we are in week 1 of Phase 1. You're hearing this on January 7th. The Bloomberg story won't break until March, giving roughly 2 months to accumulate physical silver before retail panic. February will be more expensive. March will be chaos. And by April, physical silver won't be available at reasonable prices. Now the core question, why silver instead of gold? The document says gold is obvious and traditional, held by every central bank. So gold buying sends little signal. Silver is different. Silver is industrial and strategic. So official buying signals, supply chain security, economic conflict preparation, and a national priority beyond an inflation hedge. Silver is essential to future technologies like solar panels, electric vehicles, and advanced electronics. Control silver and you influence the energy transition and critical manufacturing. Gold is historic and valuable, but it does not power solar cells or enable semiconductors. By choosing silver, the Fed signals the modern economy is built on physical resources, critical materials, and commodities. Another factor is price leverage. Gold is around $2,600 an ounce, so a meaningful gold reserve is costly. Silver is far cheaper, around 80 today. 500 million ounces cost about 40 billion at current prices. And even at 267, it totals roughly 134 billion. Manageable for the U. Is free 9, compared with massive interest payments. Silver gives maximum strategic impact with minimal capital outlay. A 500 million ounce reserve is small relative to the federal budget and creates leverage lend to allies. Withhold from adversaries. Stabilize domestic supply chains. Silver is strategic in a way gold is not. That is why the Fed chose silver and why the reserve matters. After Operation Silver Shield is complete, some expect a price collapse once the Fed stops buying. That view is wrong in this narrative. The price does not crash. It stays elevated because the fundamentals have not changed, and the structural forces behind silver demand and scarcity remain in place. Industrial demand for silver is still accelerating. Solar panel production grows about 25% per year. Electric vehicles use increasing silver per car, and electronics consume large volumes. With the Fed locking 500 million ounces into strategic reserves, the supply available to the market is permanently reduced, tightening conditions for everyone else. Miners produce about 850 million ounces annually, while industrial demand alone is near 1 billion ounces. That is already a 150 million ounce deficit. With the Fed not selling its reserve, the gap remains. Prices must stay high to destroy demand, making $267 the new floor, not the peak. From that baseline, silver can move higher. New creases, tighter Chinese export controls, mining shortfalls, or sustained retail demand could push prices to 300, 350, even 400. The move to 267 is the first major repricing, when silver is recognized as strategic. Later repricing comes when deficits become undeniable. Now consider the paper trap. Futures trade near $85 and SLV tracks spot, tempting buyers to avoid physical premiums. But paper exposure fails when supply disappears. When the Fed buys aggressively and silver cannot be sourced, paper vehicles break. What looks cheaper today becomes worthless relative to physical metal tomorrow. SLV relies on vault silver. When metal is unavailable, share creation stops. Redemptions fail. Paper disconnects from reality. SLV can trade far below physical prices, leaving holders trapped. The only protection is physical silver bars and coins under your control. In a real shortage, physical holders set the price. Paper holders get empty promises. Here is your action plan. Your go order. Step 1, buy physical silver immediately. Do not wait for confirmation, headlines, or price movement. Buy now. This week. Today. Call dealers. Order online. Accept premiums. And secure the metal. Early action is the advantage. Delay means higher prices, shortages, and missed opportunity. Step 2, diversify what you buy. Do not focus on a single product. Buy eagles, maples, bars, rounds, whatever is available. Supply will dry up quickly once panic begins. Step 3, take delivery. Do not store silver with a dealer or third-party vault. Ship it to yourself. Place it in a safe and maintain direct control. Step 4, hold. This is not a short-term trade. Do not flip silver for quick gains. This is wealth preservation. Hold through volatility, through the rise to 267 and beyond. The story does not end at that price. Step 5, ignore the noise. Analysts will call silver a bubble. Media will predict crashes. Ignore it all. They do not have the information you have. They have not seen the Jackson Hole document. They do not know about Operation Silver Shield. You do. Trust the Fed's own modeling. $267 is the target. That is where this phase ends. Do not let fear, doubt, or short-term price swings shake you out of position. Step 6, prepare mentally. The next year will be volatile and emotional. You will watch silver move from 80 to 100, then 150, 200, and 267. Premiums will explode. Dealers will sell out. Media coverage will be non-stop. If you bought early, you will be positioned and calm. This is not financial advice. This is intelligence. A battlefield report from the currency war. The Federal Reserve has admitted defeat, acknowledged hard assets matter, and declared silver strategic. Operation Silver Shield is real. 500 million ounces is real. 267 is the target. You have the edge. Act now, or miss it.